All right, let's dive into a really big story today. We're talking about Crown Castle's massive $8.5 billion pivot. This is a giant in U.S. communications, and they're basically flipping a decade of strategy on its head. So we're going to explore exactly what that means for the company, its stock, and of course, for you as an investor.
So just imagine this for a second. You spend 10 years and billions of dollars building your company in one very specific direction, only to slam on the brakes and throw it in reverse. That's exactly what's happening at Crown Castle. And believe me, the scale of this U-turn is absolutely staggering. In the price tag for abandoning that strategy, a cool $8.5 billion. That's the value of the entire fiber and small cell business that Crown Castle is now selling off. This isn't some minor course correction. This is a fundamental reshaping of the entire company.
Okay, so let's get into the weeds here. Let's look at what Crown Castle was versus what it's now trying to become.
I mean, the change is pretty stark when you see it side by side. For the last 10 years, Crown Castle was trying to be this one-stop shop for 5G, right? They offered everything from the giant towers to the dense fiber networks. But this new strategy, it completely abandons that vision to focus on just one thing, its huge portfolio of U.S. cell towers. And this is what they're aiming to be, a pure-play REIT. It's actually a pretty simple concept. Instead of spreading their bets across a bunch of different assets, they are going all in, betting everything on their core legacy business of owning and leasing out space on those towers. So you have to ask, why the sudden change of heart? Well, a huge catalyst was a massive $5 billion write-down on that fiber business. That's basically the accountants saying, hey, this thing isn't worth what we paid for it. So in response, they're retreating back to their fortress, that highly profitable, high-margin business of their 40,000 U.S. towers. Now, from an investor's point of view, this pivot might not look like a retreat at all. For some, this is a brilliant move, a masterstroke of focus and simplification. And you can see why the bulls are excited, right? The argument is pretty compelling. A simpler business is just easier to understand, and it focuses only on those high-margin tower assets with really predictable cash flow. And the money from the sale, well, that's going to fuel a new $3 billion share buyback, which bulls are hoping will finally close that valuation gap between Crown Castle and its peers. But of course, there's always another side to this story. Simplifying the business also means you're concentrating the risk. For the bears, this move looks less like a masterstroke and a lot more like a high-stakes gamble. And here it is, maybe the single biggest risk you need to understand: customer concentration. A whopping 74% of the company's revenue will now come from just 3 customers: T-Mobile, AT&T, and Verizon. So think about it. If just one of them decides to cut back on spending, it creates a massive problem for this new, leaner Crown Castle. And look, it's not just investors who are getting a little worried. The credit rating agencies are watching very closely. Moody's has already shifted its outlook from stable to negative, and they're pointing directly to the company's new, more aggressive debt target as the reason why. More debt simply means more financial risk, especially in a world with higher interest rates. And then there's the dividend, a 32% cut. Ouch. For years, Crown Castle was this reliable income growth stock. This move completely changes that whole investment thesis, and it could really alienate the core group of shareholders who are counting on that steady income. And here's the bottom line for those income investors. After that cut, Crown Castle's dividend yield offers almost no premium over a 10-year U.S. Treasury bond. So you really have to ask yourself, why take on all the risk of owning this one stock when you can get a similar payout from the U.S. government, which is, essentially risk-free? So you've got these two competing stories, the bulls and the bears. How should an investor even think about the stock price right now? Is it a total bargain waiting to be unlocked? Or is it actually fairly priced when you consider all these new risks? Well, historically, Crown Castle has always traded at a bit of a discount to its main rival, American Tower. But if you look today, using a key valuation metric, enterprise value to EBITDA, they're now trading right in line with them. But here's the kicker. Their businesses are now very different. Competitors like American Tower have these huge international operations, which offers a kind of diversification that the new U.S.-only Crown Castle just won't have. And this really just boils it all down to one single question, doesn't it? The bulls will tell you, no way, the simpler, focused company deserves a premium valuation. But the bears will come right back and say, absolutely. That lack of diversification, the customer concentration, the lower growth, all of that fully justifies the historical discount. So to try and wrap this all up, let's frame this as a series of key questions. These are the things you really need to answer for yourself before you even think about making an investment decision here.
First up, execution risk. I mean, selling off an $8.5 billion business is incredibly complex. Can the new management team actually pull this off smoothly and on time? Any kind of delay or hiccup could seriously damage investor confidence. Second, let's talk financial risk. Is taking on more debt really a wise move in today's interest rate environment? Like we saw, Moody's is already raising a red flag, and a potential credit downgrade could make it way more expensive to borrow money down the road. Third, capital allocation. The company is basically swapping its old dividend growth story for a new share buyback story. The question is, will management be savvy enough to buy back shares at good prices to actually create value? Or are investors just going to miss the predictability of that old dividend? And finally, we get to the most fundamental business question of all. Is the expected 5% growth from the core tower business, is that really strong enough to carry the whole company forward? Is that enough to make up for ditching the potential, albeit riskier, growth they had from fiber? Which, I think, brings us to our final thought. Is this massive pivot a masterclass in strategic focus? A brilliant move to simplify and squeeze every drop of value from a core asset? Or is it a defensive retreat from the future of 5G, basically giving up ground to competitors and accepting a lower growth future? The answer to that question is what will ultimately determine the fate of this $8.5 billion bet.